Bismillah ar-Rahman ar-Rahim. Assalamu alaikum wa rahmatullah. In this video, I will discuss the material we should be covering in chapter 2 to make it more informative and to make the time you spend on this lecture beneficial. I suggest that you do the following. Now I will discuss some topics, and I will ask some questions since nobody is with me right now. I will pause for a few seconds so you guys can think of an answer, and then I will answer this question so you can compare your answer with my answer, and you will be able to identify if there are any gaps in your understanding. Okay, chapter 2 focuses mainly on the mechanics of futures markets. This last part of the chapter we will be discussing a little bit the evolutions or developments in the OTC market. Futures markets are not new. In fact, the Futures Industry Association claimed that there are evidence of forwards or futures contracts that existed 4,000 years ago. But what we know for sure is that one of the oldest marketplaces where futures were traded is the Dojima rice market in Osaka, that's in Japan. And that market started in 1730. The Chicago Board of Trade itself, which is one part now of one of the largest exchanges in the world, was established in 1848. At that time, most futures contracts were on agricultural products, and actually the motivation of the futures markets and futures contracts is to smooth the distribution of supply and demand throughout the year. In the past, before these markets existed, farmers they have a certain period of the year where they can collect their harvest. So they take it to central markets, central distribution markets like the Chicago to sell their products, and they hope that they will be able to meet clients and buyers who will pay for their agricultural products like wheat, for example, cotton, corn, and so on. But at that time, it's not only one farmer who will be collecting his harvest. There are also tens, if not hundreds, of farmers, and they all meet at the same marketplace. So what happened is there will be a large supply and not enough demand to the extent that prices will drop. Usually that happens in September, November, and so on. By the end of the winter and probably beginning of the spring, there will be a big shortage of these products, and the price will be very high. The reason is that there was only one time in the year where buyers and sellers can meet and exchange their and make a deal. Merchants came up with this idea that farmers will come without their products and make a deal. So the deal is they will be delivering a certain amount of agricultural products on a certain date sometime in the future. So the buyer and the seller agree on the price. Everyone now is happy that they already know that the products that we have, we will be able to sell it. So they will deliver it on the date agreed on in the contract. Futures contracts at the beginning were known as to arrive contracts. Before we continue, we need to remember what are the major differences between derivatives markets and spot markets. Now, these two markets differ in three major elements. The first one is delivery of the underlying. In the spot market, the delivery of the underlying will take place right away, usually, or even a few hours, or probably in a very short period of time, just to take care of the logistics. In the derivatives market, the delivery could take place after 1 month, after 1 year, even sometimes after 10 years. So the delivery in the derivatives market takes time, some time in the future. With respect to the timing of payments in the spot market, again, timing of payments takes place when? Right away, exactly. But in the derivatives market, the payments will be made sometime in the future. With respect to the life of a contract, in the derivatives, in the spot market, the life of any contract, usually it takes a couple of seconds or even a couple of hours or a very short period of time. But in the derivatives market, the timing of or the life of the contract could last for years. Now we focus on the futures contracts, and there are futures contracts on a wide range of assets. So on agricultural assets like wheat, soybean, even coffee, cotton, and so on. There are derivatives contracts on metals like iron, aluminum, copper. There are contracts on energy products like oil and gas. There are contracts on precious metals. There are even contracts on cryptocurrencies. So in 2018, the CME group introduced products, futures contracts on Bitcoin. So as long there is the demand on a certain contract, any exchange will be happy to introduce such contracts to the market. We know that futures contracts are exchange traded, and when we say they are exchange traded, it means that transactions are cleared by a clearing house. So what's the purpose, or what do we mean by a transaction is cleared by a clearing house? It means that a transaction is recorded, so both it will be recorded to indicate who's the buyer, who took long, and who is the seller who took short, and what's the number of contracts, and what's the price, in addition to the other details. So and the reason to record these transactions is to ensure or confirm that there is a deal. So no one will back up and say, okay, no, I didn't make this deal. That's one purpose of a clearing house. The second purpose of a clearing house is to ensure that the transaction will be fulfilled on the delivery date. So after the contract stops trading. And what we mean by this if something happened to one party, for example, a person took a long and the person who took a short defaulted, or something happened that prevents him from meeting his obligations, then the exchange will assume the short person's position. And the reason any exchange is the reason why any exchange will do that is because it wants to ensure that there will be trust among market participants. Because once the market or an exchange loses its participants' trust, the amount of trading that takes place will decrease and probably stop completely. And if that happens, well, any exchange will lose their source of revenue, which is the commissions that they receive from any transaction, and they will close. Now, in any futures contract, there are specifications that need to be defined. These specifications include what can be delivered. That includes the asset size, the underlying asset, and what's the contract size. Where it can be delivered. So the exchange will determine an alternative locations in which the delivery can take place, and when it can be delivered. Also, it will determine a period in which the delivery should take place. The last distincting feature of futures contract is that they are settled daily. And what we mean by daily settlement, the gains or losses for any market participant will be realized on a daily basis. And shortly we will see in an example how such gains or losses will be realized through the margin account. Now, examples of contract sizes: oil has 1,000 barrels. That's usually the standard. With respect to gas, it is 10,000 million British thermal unit, which is a standard measurement of gas in the industry. For gold, it's 100 troy ounces, and for corn and wheat, it's 5,000 bushels. And a bushel usually looks like this basket. Now, a question that can arise to any person who's seeing these numbers is that how will an exchange determine a proper number for a contract size? Now, for example, why they don't say instead of 100 troy ounces, they will say, for example, 1,000,000 troy ounce. Well, if there is 1,000,000 troy ounce and each ounce will cost 1,500, so the value of one contract will be 1.5 billion. And this is a huge contract or a huge commitment that not everyone can take. So if that's the case, then there will not be enough, or the volume will be very low. And if the volume is very low, then the exchange will lose potential commissions from trading this contract, futures contract. On the contrary, let's say, so now we agree that they don't set the contract size to be too high to stimulate trading, so to motivate speculators and hedgers to use these futures contracts in their transactions. On the other hand, they don't make it too small, like 10 troy ounces instead of 100. Well, if they make it 10 ounces, and for example, a person wants to hedge 100 ounces of gold, then he has to buy 10 contracts, which means he will have to pay a larger amount of commission, because there will be commission on each contract. So too small means there will be higher transaction cost to transact or to use this futures contract. A high contract size might prevent trading at all. Okay, now with respect to how the prices move in the futures market relative to the spot market, now we know that there should be a fundamental relationship between futures price and its and the assets and its underlying asset spot price, but movement of these two prices in the market could vary. Now it is possible that the futures price will be at the beginning, when the contract is initiated, the futures price will be higher than the spot price, or it could be lower than the spot price. Now what we see here is that as the time passes and we are reaching the delivery date of the futures contract, the difference between the spot price and the futures price will be smaller and smaller until we reach the delivery date. Okay, and this is true whether we are dealing with whether the price of the futures price started higher or lower. Now why do we see this? Now let's assume that I entered into let's say a futures contract to buy oil, and today is February 6th. Okay, so the futures price is 56 and the spot price is, let's say, 50. Now this futures contract will expire on March 1st. Okay, here we have 6. Okay, now let's assume that time has passed, so we are now today on March 1st. On March 1st, we observe that the spot price is equal to 55. The question is, what should be the futures price for a contract that will expire on that day, on March 1st? Should it be higher? Should it be lower? Or it should be equal? Well, if someone thinks that it should be lower, then, or it should be higher as it started in February 6th, then there will be an arbitrage opportunity. So what I will do, I will enter into, I will buy from the spot market at 55, and let's say if we assume the price was 60, I will enter into a futures contract for delivery on March 1st and wait a couple of hours until the contract stops trading, and then I deliver this barrel of oil that I bought from the market at the higher price. So because of the possibility of an arbitrage, the existence of an arbitrage opportunity, we, on the delivery date, okay, we will see the futures price should be equal to or very close to the spot price on that day. Okay, let's go back. Now we turn to margin accounts, or sometimes it's called a performance bond. A margin is a cash or marketable security deposited by an investor with his or her broker. So any investor who enters into a futures contract, whether this person is whether this person took a long or took a short position, they have to maintain some cash in or a margin account. Now, this amount, in the margin account, you can deposit cash or highly liquid securities like treasury bills or stocks. But when you're dealing with treasury bills or other with the marketable securities, usually for the purpose of margin account, they will not consider their whole value. They might consider 80%, 50% of its value. The balance in this margin account will be adjusted on a daily basis to reflect daily settlements. And what we mean by these daily settlements is to, if there is gain for one party, it will be taken from the other party's account and will be deposited back to the other person's account. And the reason that margin accounts exist is that by doing these daily settlements, there will be a very low, and some argue that there will be an almost zero chance of default from one party to another, or a loss because of such a default. So if one party defaulted, will not meet his obligation, already the gains are realized by the other person in his account. Now, whenever we are dealing with margin accounts, we need to keep in mind four terminologies, four terms that are used a lot in this market. Now, when an investor enters into a position, whether it's a long or a short, in a futures contract, he has to deposit an amount that equals to the initial margin. So the exchange will determine a certain amount that will be the initial margin, and the balance in this margin account should be always higher than the maintenance margin. If for some reason and because of daily changes in the account, the maintenance margin, the balance in the margin account is below the maintenance margin, then the investor will receive a margin call. If this investor did not deposit cash, and this investor has to deposit cash to bring the balance back to the initial margin level. If the investor does not take any action, does not deposit cash in his account, then the exchange will liquidate his position and put him in a blacklist, and that investor will be banned from trading in that exchange. So they take it very seriously to minimize the possibility of credit risk or a problem that could exist to not only one person, to the whole market because of credit risk. So let's see again here what is happening. So here, let's say time. Okay, here is the balance in the margin account. So when an investor starts trading, he has to deposit the initial margin. Okay. And the balance in his account should always be above the maintenance margin. Okay. if the balance for, let's say the initial margin for example is 2000 and the maintenance margin is 1500. If the price became below 2000, but let's say it was 1600, then the investor is not obliged to do anything. If it reached 1500, still the investor is not obliged to do anything. If the balance reached 1499, then this investor is going to receive a margin call, and he has to bring back the balance to the initial margin level, which is 2000. So for example, if the balance reach 1499, then he has to bring the balance back by paying 501. Okay, and this 501 is called variation margin. Okay, so again we have an initial margin, we have a maintenance margin, we have a margin call in which an investor has to take an action, and we have the variation margin. Okay, let's take an example of an investor who is who decided to take two long positions in gold futures contracts that will be delivered in December, and the time when he entered into this contract, it was June. So the contract size is 100, the futures price is 1450. The initial margin is 6000 per contract, so in total this investor has to deposit 12,000 because he entered into two contracts. The maintenance margin is 4,500 per contract, so in total the balance in his account should be greater than 9,000. Okay, طيب. What we observe, okay, when the investor entered into this transaction, the price was 1450. Now by the end of the day, an important price all market participants will keep an eye on is what is the settlement price. Why this is important? Because it will determine by how much your margin account will change. So for this investor, by the end of the day, the price dropped by $9. Now his daily gain is 1,800. How did we come up with the 1,800? Well, we have two contracts, right? And in each contract, it's for 100 ounces. And we always have here two prices: the price in which we took a long and the price which we assume we were going to take a short. So this investor took a long with 1,450. By the end of the day, just for the sake of calculating how much will be my gain or profit or loss, we will consider that he's going to take an opposite position. So by the end of the day, he's going to take a short position, and the price at which he sold the contract was 1,441. So this means there was a $9 loss per ounce times 200. That will give us minus 1,800. So here we see the daily gain in the investor's margin account is actually negative, which means it's a loss. So the margin balance will be reduced by this amount, and by the end of the day it will be 10,200. Is the investor going to receive a margin call here? No, since it's above the 9,000, no margin calls will be made. Now the series of losses continued. The second day the price dropped. So for the purpose of calculating the daily gain here, what we will do is that we are going to assume that he's entered into a long position with the new price and closed with the settlement price. So the daily gain for the second day will be 2 times 100 times 1441, and here it's 1438.3, so that will give us 540. Yes. Okay, so we see here the change in the second day will be by this amount, and we continue this process day after day. So on the sixth day the balance reached 9,240. Is the investor going to receive a margin call? No, since the price is or the balance is above the maintenance margin. Now on day 7 the price dropped even further, so that day's loss was 1,260. The balance in his account reached 7,980. So he has to deposit now. He will receive a margin call because the balance is below 9,000, and he has to deposit and cash enough to make the balance back again to 12,000, which is the initial margin level. So in our case here, he's going to pay 4,020. What do we call this 4,020? We call it variation margin. Okay. Now on the 8th day, the price went up a little bit. So here we see that the balance is above 12,000 and became 12,180. If the balance in the margin account is above the initial margin, any cash above the initial margin could be withdrawn. So the investor can withdraw, for example, in our case here, 180. In this chart, we observe how the margin cash flow moves, okay, when futures prices increase. So when the futures price increase, who is going to gain and who is going to lose? Is the long person or is the long trader going to gain or lose? And the same question applies on the short trader. Now, since the long trader entered into a commitment at a lower price, and if he wants to exit from this investment, he will be selling it at a higher price, then he's the guy who is going to gain. So he's the guy whose margin account is going to increase. Now, from where we take this cash, we will take the cash from the short trader. So the short trader is going to lose because he's selling. If he wants to close his account or his position, he will lose because he still sold the contract at a certain price, and then he has to buy it at a higher price, so then it will be a loss. So what will happen? Cash will be taken from the short trader's account to the broker, to his broker, and then to his clearinghouse member, and from the clearinghouse member it will be delivered to the clearinghouse. The clearinghouse will transfer funds to the other clearinghouse member and to the broker of the other investor, and it will end up in his in the account of the long trader. Now, if the futures price decrease, then the long trader is going to lose and the short trader is going to gain, and cash will move in the opposite direction to the previous chart. Important terminology that we need to also keep to be aware of and understand when we are dealing with futures market includes an open interest. Open interest is the total number of contracts outstanding. So this equals to the total. It equals to the number of long positions or the number of short positions. Okay, let's see here how open interest changes in any futures market. Let's assume we have a person, let's say Yasser. Yasser entered into a futures contract to buy wheat with Ahmed. Okay, so Yasser took long, Ahmed took short. So how many outstanding contracts we have? 1. Okay, so the total number so far of contracts outstanding is 1. Yes, when you have 1 long and 1 short. So to remind ourselves here, Yasser took long, Ahmed took short. Now in another transaction, Maryam took long and Shahad took short. So how many number of contracts we have outstanding? 2. So we will observe that we have 2 long positions and we have 2 short positions. Okay, before we proceed, let's look here at another important figure that represents or it gives an indication of trading activity, is the volume of trading. So open interest and volume of trading are indicators of intensity of the trading activity. Now volume of trading is the number of trades in one day. Okay, in our previous transaction here, there are 2 open interest and there are only 2 transactions, so the volume of transactions is also 2. Now let's assume that Abir, okay, negotiated with Maryam. Maryam wants to exit from this transaction. So now for Maryam to exit from or to close her position, she will take short and Abir will take long. So the contract will be now between Abir and Shahad. Maryam, okay, and Shahad will have no relationship or there will be no transaction. Now what is the total number of what's the open interest? We will observe it's still 2. Okay, but what's the volume of trading now? Well, there was a transaction between Yasser and Ahmed, another transaction between Maryam and Shahad, and then a transaction between Abir and Maryam, in which Abir assumed Maryam's position, and now the contract is between Shahad and Abir. So the volume of trading is going to be 3. Okay, let's assume Yasser and Ahmed decided they want to exit from this investment. So Yasser is going to take a short position instead of a long, and Ahmed will take a long instead of short. So their commitment will be cancelled. Now, what do we observe happens to the number of open interest? Now it became 1, and the volume of trading so far is going to be 4. Okay, so 4 transactions took place, and we are left with 1 open interest. Okay, I want to ask you this question. Now, from this small simulation of futures trading, when do you notice that the number of open interest increases, and when do you notice the number of open interest remains the same, and when do you notice the number of open interest decreases? So I will leave this question for discussion on Slack. Okay. An important price that investors keep an eye on is the settlement price. So it is the price that is used daily for the daily settlements. Now, how the settlement price is determined? Well, this is up to the exchange to determine what is the proper mechanism to calculate the settlement price. It is possible that in the past the settlement price was the price at which last trade took place, and there is a problem with using this price. What do you think is the problem of using the last price as the settlement price? Well, as you can expect, it is because it could be subject to manipulation at the end of the trading day. An investor can manipulate the price for various reasons by entering with a very big buying position or a very big selling position. Okay, the mechanism of determining the settlement price differs from an exchange to another, but it has evolved, and it's the objective is to reach a price that represents what would be the last price that took place for that for that contract. Okay, again as a review. Now, we have to remember when we are dealing with futures that they are settled daily, and whenever we are mentioning that an investor wants to close an account or close a futures position, then this means that this person is going to enter into an offsetting trade. So closing your position, if you're taking a long, means you need to take a short. When you take a short, you will offset your commitment, so that means you have zero commitment. If you took a long, then the offsetting trade will be short. If you are short, then the offsetting trade will be long. One key observation about futures contract is that they are closed out before maturity. Of course, not all of them. About 93% of futures contracts are usually closed out before the last trading day. And when we are dealing with futures again, we will, if you look at the specifications of the contract, they will determine, okay, let's assume this is the timeline. Okay, this is the day 0 in which we started trading. There will be a last day to trade, okay, and then there will be a delivery period. period. Okay, so usually in most futures contracts, trading will take place until just the last day to trade. About 93%, 94% of participants will close their account. Why? Because once, if your position is still open after this day, then you are stuck with the delivery. So if you are entering into this into futures for speculation, you will be in a big problem, because you are now committed to receive or deliver the underlying. If you are entering into this contract for hedging purpose, still it might be sometimes in your interest to close the account, because the location of delivery might be far from where you need the underlying asset. So you close this account and benefit from the price change, and buy it from a local in your local market. Okay, here you will see a snapshot of the activity of futures on crude oil that was traded in 2013. You will see here that there are contracts with different maturities. There is the open price, the highest price during the trading session, the lowest price during the trading session, the prior settlement, and you will see the last trade that took place when we took the snapshot. There is the change and volume. To make this lecture more relevant to what's going on today, let's look at some sources that provide futures markets, the status of the futures market today. So the Wall Street Journal is one important source that will show you what's going on in the futures market. I highly suggest that you guys subscribe to the Wall Street Journal, at least during the course, so you will be aware of what's going on in the futures markets in general, and in the economy, the US or global economy in these days. طيب, let's look here at crude oil futures. So here they picked some of the highly traded contracts to show them on the first page. Now here we will look at a certain contract in more detail, and you will see the price, okay, in the past five days. And here you will see, just a second, see all contracts. They are having a problem since the last time I looked at this website. Okay, let's look at the CME group, which is more probably more accurate. Okay, here. So again, last the change in price, opening price, what's the highest, what's the lowest, and when the trade took place. Okay, in the CME group, if you go to markets, you will see some featured products in that exchange, like corn futures, soybean futures, the Western Texas crude oil, Henry Hub natural gas, and so on. Here they classified futures contracts and some options also based on the category of the underlying asset. Let's look at the cryptocurrency. So this is a contract that they introduced about 2 years ago. Now the price today, okay, is about 9,726, and there is still trading. So let's look at the futures price. Okay. There used to be a page where they show you the prices for different maturities. Okay, let's look at something. Let's look at the crude oil. So here there are the key elements in the contracts determined by the exchange. Let's look at the contract itself. So here we have contracts with different maturities, and it will give us the last price, prior settlement, open, high, low, and volume. If we go to the volume, we will see also the number of open interest. So we will see a volume determined by on which market it has been traded, and there is the number of open interests. Okay, so notice here the relationship between the total volume and number of open interests, especially for the near-term contracts. So the contract with the closest maturity, usually it's the contract that is highly traded. So you notice here the volume is way bigger than the number of open interests. Okay. Next we move to discuss a little bit the developments in the OTC market. Before the crisis in 2008, the OTC market used to be highly opaque, which means there was no transparency. No one knows what is going on there, what's the transactions that are taking place. And after the financial crisis erupted, there was a huge political pressure on the OTC markets to change. So before we discuss the change in the OTC market, we need to learn that Any contract in the OTC market is usually governed by what's called an ISDA master agreement. ISDA stands for the International Swap and Derivatives Association. They provide a template, a legal template of a contract for participants to fill in whatever terms they agree on in that contract. So the reason is to they come up with this template is to facilitate the transaction and make coming with the deal and writing up the contract much easier task. Now, after the crisis happened, there was a political pressure on participants in this market to move towards a structure that is similar to organized exchanges. So participants in the market needs to keep a collateral, okay, with a third party when they enter into a forward contract. What do you mean by a collateral? A collateral, it's in Arabic أصل مرهون. So it's an asset that is kept, okay, under the hand of someone else. So in case if you are not able to fulfill your commitment, the other person will assume ownership of that asset. Now, when collateralization existed in the OTC market, participants now added what's called a credit support annex to the ISDA master agreement, and this is describes how or what will happen to that collateral whenever there's an evaluation of the forward position. So it will function in a way like a margin account. So there will be a valuation of the transaction, and if the gains or losses reach a certain level, then the person who is losing should should provide a collateral worth the variation margin, okay, to the other person. Okay, so here it's a little bit additional description of this idea. Now, an important development that took place in the OTC market is that now participants are required for most standardized forward contracts to clear the transaction through a central counterparty or a CCP. Now, central counterparties are people who are not involved in this transaction, but they will act as a clearinghouse. So if the long position holder defaulted, the central counterparty will assume that person's position. And the reason that the market is moving towards a CCP structure is to reduce again their credit risk and ensure that transactions will be honored and met in the right time. So a CCP is like a clearing house, will require an initial margin, and if the amount or if the asset value is below the maintenance margin set by the CCP, then there will be a variation margin that has to be deposited. And CCP also, they have members, and those members have to contribute to a default fund. In case one member defaulted, because of too many transactions that went bad. So to ensure the stability of the system, they will take fund and inject it to that member to make sure that he will not, or she will not default. Now this graph or this picture will show how the network of participants in the OTC market used to be before the existence of CCPs and after the existence of CCPs. Now let's say here there is investor A, B, C, D, E, F, G. Each one of them has transactions with the other, so they know each other, okay, right away. They did the transaction right away with each other. But if something bad happened to this person, well, probably the whole network will collapse. Now, when they move toward a central counterparty or a CCP structure, each investor now is has a commitment with the CCP. So if that person has a commitment with this person, it's going to be through the CCP. So if there is a problem that existed with this person, the CCP will take care of it, and we will ensure that the system will be stable. So there are a lot of developments that are taking place in the OTC market. You can refer to it in the chapter. Now we will go back to futures contract, and we will discuss the delivery part of these contracts. Now, if a futures contract is not closed out before the last trading day, then it will be usually it will be settled by delivering the asset. So the exchange usually in each contract will determine a range of locations, or a list of alternative locations where the delivery can take place. The question is, who determines where, okay, from these alternatives the delivery will take place? It's the person who has the short position. So the person with the short position will determine where they can deliver, where the delivery will take place. Now, not all futures contracts will be in not all futures contracts there will be a physical delivery. Some contracts they will be settled in cash. An example of such contracts are futures on a stock index. So, for example, if we have a futures on an S&P 500 index, then will be impossible to deliver a portfolio of 500 stocks. So instead, we will be evaluating what is the position, okay, at the time the investors entered into, and what is the position when it is closed, or when it is when the contract stopped trading, and the difference will be paid from the person who is losing to the person who is winning. Let's look at an example. Now, how forward contracts or futures contracts on the S&P 500 work? It is usually valued by, or the value of the contract is determined by specifying a certain number times the index. So for the S&P, usually it's 250 times the index level, $250. So if the index level, let's say, was 1,000, then the value of the contract is 2,500. sorry, 250,000. Now, if a person entered into a long position in in this contract when the value of the index was 1,000, of course, there is another person who should assume a short. So let's say A took long and B took short. Okay, now the contract stopped trading and now it's time for delivery. And when it's time for delivery, the index level reached 1,100, which means the value of the contract is now just 1 second. So it's going to be 275,000. Now here we will assume that A, okay, once there will be a delivery, A will take a short, so, and B will take long. Okay, so what will be the gain for one of them and the loss of the other? A entered into a long when it was 250 and then took a short when it reached 275, so he gained 25,000. Now B took a short, so he sold it when it was 250, then took a long when it was, and bought it again when it was 275, when the value of the contract is 275, so he lost 250. So what will happen here is that investor B will deliver to investor A 25,000. Now if you are trading in a futures market, usually the gains are going to be realized on a daily basis. So on the last when the contract matures, probably the investor B will add only a little bit, okay, to make the total amount delivered to A 225,000. So at the end, what we mean by settled in cash, we will see who is winning and who is losing, and the person who's losing will pay the amount to the person who's winning. Okay, now before I continue, let me ask you this question, and I want you to think about its answer. When a new trade is completed, what are the possible effects on the open interest? Is it going to increase? Is it going to decrease? Or it's going to stay the same? That's the first question. The second question, can the volume of trading in a day be greater than the open interest? So we are not saying should it be always, but is it possible that the volume of trading in a day will be greater than the open interest? We'll be looking for your answers in Slack. Here we will be discussing some of the or the type of orders that usually take place, not only in exchanges, also sometimes in some stock markets. So some of these orders should be familiar to you by now if you took a stock market related course. A limit order is an order where you set a price, so it will be executed if the market prices reach the price you set. A stop loss is an order that will determine, it will determine a price probably lower than the price you entered into that transaction, to make sure that If the prices reach that level, the order will become a market order, so it will be traded at the best available price. A stop limit is similar to the stop loss, but it differs in that if the price reached a certain level, then the order will become a limit order at a predetermined price. Market if touched, it's the opposite of a stop loss. The stop loss is there to ensure or to control the amount of losses. Market if touched is there to make sure that you lock in a certain profit. So if the price increase to a certain level, then the order will become a market order, and it will be executed at the best available price. The book describes also different other orders, so I suggest that you guys refer back to the book. Now, whenever we are trading securities or derivatives, we need to be aware of the transaction costs. So, for some investors, there are floor trading and clearing fees, and these costs applies to people who are trading in the physical exchange itself, and they are assuming a role of kind of a member. So this investor is making a lot of trades on his behalf or on behalf of someone else. So there are floor trading and clearing fees that has to be paid. So some investors are willing to do this or to take this to assume a similar position because they want to avoid paying a high amount of commission. They are able to meet with the other parties in the market directly. Now, for smaller traders, usually it's not possible to trade in the exchange itself, so it has to be through a broker and or another clearing house member. So in every trade there is a commission that has to be paid. Now, other costs associated with futures contracts and also other contracts is the bid-ask spread. Now, let's look here at a scenario in which one investor decided to buy a futures contract on silver, and let's assume when he went to the market maker, he quoted to him the following bid and offer prices or bid and ask prices. So if you want to sell the asset to the market maker, you have to pay 24 or 25. If you want to buy it, you have to pay 26. So you notice here it will cost you higher, so that's at the same instant. So let's assume you entered into this transaction, so you will be paying 26 to buy or to assume a long position. Now, after a few minutes, you decided, I want to just exit from this transaction. Then you have to sell it back to the market maker. The price he's willing to pay is 25. So here you lost $1. This $1 is the bid-ask spread, and we should keep it in mind whenever we are considering the transaction cost associated with the trading that we are doing. If we didn't close our position before the last trading day, and we are going to assume delivery, then we have to also keep in mind that there are delivery costs. Okay, taxes also, they are considered a cost that we should keep in mind whenever we are dealing with these transactions. Most organized exchanges or markets, there are regulatory bodies that ensures that the tradings are fair and the practices are not in favor of a certain person or a certain group. So for the futures market in the US, the regulations of these markets is the responsibility of a commission called the Commodity Futures and Trading Commission, and their ultimate objective is to protect the public's interest and make sure that trading is taking place in a fair environment. So here we have here in Saudi Arabia, the organization that is responsible of issuing regulations is the Capital Market Authority, SEMA. Now, the last issue we are going to discuss in this chapter is the accounting and tax treatment of a futures transaction. Now, the key answer to the question of how we should record a particular derivative transaction in a company's book. Well, the answer to this is it depends on whether or not a derivative transaction is qualified to be considered as a hedge or not. If it is qualified to be considered as a hedge, then there is a certain accounting treatment. If it doesn't qualify to be considered as a hedge, then there is a different way of treatment from an accounting point of view, and it is usually considered as a speculative transaction. Now, let's take an example of a futures transaction. So assume that today is September 2019. Okay? A company entered or took along a long position in March 2020 corn futures. Okay, now this company closes out their position at the end of February 2020, so before the last trading day in that contract. Okay, Now the prices are as follows. So when the company entered into the contract, when the company entered the contract, the price was 650 cents per bushel. Okay, or $6.5. Now, at the end of 2019, so that's December 31st, the price, the futures price, is 670 cents per bushel. And the price when the company closed their position in February 2020, the price is 680 cents. Now, if the transaction qualifies to be considered as a hedge, so the gains or losses will be realized when the transaction is closed. So in our case here, we entered into the contract in 2019, okay, and closed the transaction in February 2020. So we will see whether this transaction, in this transaction we made a gain or we lost, and this gain or loss will be recorded in the income statement of 2020. So in 2019, this transaction will not be recorded at all. Now, if this transaction does not qualify to be considered as a hedge, then it has to we have to see, okay, what is the price change in 2019. So we will assume at the end of 2019 the company will close their position, and at the beginning of 2020 they will enter into a new position. We will see what is the gain or loss in 2019 we recorded in that year's balance sheet or income statement, and what is the gain or loss in 2020, and we record the gains or losses in 2020's financial statements. So in our case here, if the transaction qualifies to be considered as a hedge, then the gain will be calculated as follows. So they entered into one contract. Each contract is for 5,000 bushels. So 5,000 bushels times the price when the company entered into this transaction is $6.5 or 650 cents, and the price when they close this position in February 2020 was 6.8. So the gain from this transaction is 1,500, and since we closed the transaction in February 2020, this 1,500 gain will be in the financial statements of 2020. And again, how we can deal with the derivative transaction this way, if it is qualified to be considered as a hedge. And who determines whether or not it qualifies to be considered as a hedge? There are certain conditions, certain rule, that based on this rule, a company can classify a certain derivative transaction as a hedge transaction or not as a hedge transaction. Okay, now this is a case of qualify as a hedge, and here does not qualify as a hedge. Okay, so if it doesn't qualify as a hedge, we will see what is the price change in 2019. So at the end of the year, we will consider the company entered into an offsetting position, and at the beginning of the new year, we will assume that the company will enter into the position again. This practice is called mark to market. So when you're marking to market, we are representing the fair value of the transaction in our books. There is a video on Blackboard that explains more the marking to market practice. Okay, so here when the transaction is not qualified to be considered as a hedge, so the daily gain or the gain that will be considered in 2019's book is based on the price movement in 2019. So at the end of 2019, the price was 670 cents, and the price at which we entered into this, the company entered into this futures contract was 650 cents. So the gain will be 1,000. This will be considered in the financial statements of 2019. Now, for 2020, we have 5,000 bushels times the price at which the company closed their position actually, minus the price at the beginning of the year. Okay, and here we will have 500, and this 500 will be considered in the financial statements of 2020. Okay, so taxes also follow the same logic, and this will conclude our discussion of chapter 2. Here is just a quick comparison of how the foreign exchange contracts are quoted in the futures exchange and in the forward exchange. In the futures exchange, they're quoted in an indirect way. So they are quoted as the number of USD dollars per unit of foreign currency. So for example, if the foreign currency is a euro, here we will see the futures contracts are quoted as how many USD dollars for 1 euro. If we are dealing in the forward exchange market, then if we are dealing in the forward market or OTC market, forward contracts are quoted, the prices are quoted as the number of units of the foreign currency per $1. So in our case here, how many euros per $1. Okay, and this concludes our discussion for chapter 2. I wish you a good luck, and I hope you were able to learn something from this video.